Every debt you have ever signed is really a sentence with two halves. The half you read said how much and by when. The half you didn't read said what happens if you don't. And that second half is the only part that ever mattered because it decides how much of your life the lender is allowed to reach into when things go wrong. That's the ladder we're climbing, not the size of the number, the size of the reach. There are 8 kinds of debt in an ordinary American life, and they look almost identical on a statement. Same dollar signs, same due dates, same polite language. But one of them can take your paycheck without a judge. One can take your car while you sleep. One can take your house, and one of them cannot legally touch you at all no matter how badly you fail. Most people find out which is which in the worst possible order. Level 1 is the debt that never announces itself as debt. The phone you're paying off over 36 months at 0%. The couch on the store card, buy now, pay later, split into 4, and the checkout button doesn't even use the word loan. You feel like a customer, not a borrower, and that's the design. What it does to you is small and structural. It moves your future income into your present month, one purchase at a time, until a meaningful slice of every paycheck is already claimed before it lands. Nothing has gone wrong. Nobody's calling. You just have less room than the number in your account suggests, and if you were asked to add it all up on the spot, you couldn't. Level 2 is the mortgage, and by any honest measure, this is the best deal a normal person is ever offered. 30 years, fixed, at a rate no business borrower could match without collateral and a lawyer. What makes it good isn't the rate, it's the predictability. The payment in year 28 is the same number as year 1, while wages and rents around it climb, so time quietly works on your side instead of against you. And the reach clause is narrow. Default, and the lender takes the house, but the process is slow, public, and full of stopping points. Foreclosure in most states runs months, and in some, over a year. The debt is enormous, and the danger is measured in seasons, not days. That's what a good loan actually is, a big number attached to a slow consequence. Level 3 is student loans, and here's where the rules change without warning. Federal student debt outstanding in the United States is roughly $1.6 trillion, spread across more than 40 million borrowers, and it behaves like nothing else in the system. Miss enough payments on a federal loan, and the government does not need to sue you. It doesn't need a judgment, a hearing, or a courtroom. It can move administratively, offsetting your tax refund, and in ordinary times, garnishing a portion of your wages directly through your employer. The Department of Education is the only creditor in your life with that power over an unsecured debt, and it has it because Congress wrote it that way. And then there's the part almost nobody understands until they need it. Student loans are, in nearly all cases, not dischargeable in bankruptcy. Every other consumer debt on this list has an exit door. The card balance, the medical bill, the personal loan, all of it can be wiped in a bankruptcy filing. Student debt survives. It follows you through job loss, divorce, illness, and into retirement, where it can reduce Social Security payments. Hundreds of thousands of Americans over 60 are still carrying it. So the debt sold to 18-year-olds as the safe, responsible, invest-in-yourself option is, in its legal structure, the single hardest debt in American life to escape. There is no repossession because there is nothing to repossess. The collateral is you. Level 4 is the auto loan, and this one is fast. Cars are collateral that moves, which makes lenders act quickly and cheaply. In most states, a lender can repossess without going to court at all. No judgment, no notice, provided they don't breach the peace doing it. 2 payments behind and a truck can come at 4 in the morning and take the vehicle out of your driveway while you're asleep. Then it goes to auction, sells for less than you owe, and you get billed for the gap, the deficiency balance, meaning you now have a debt with no car attached to it. And because average new car loan terms have stretched out towards 6 and 7 years, while the vehicle depreciates faster than the balance falls, huge numbers of borrowers spend years underwater, owing more than the thing is worth. The reach here isn't just financial. It's your ability to get to work, which is the thing that pays every other debt on this list. Level 5 is credit card debt, and its power is different again. The card issuer has no collateral. They can't take anything without suing you first. What they have instead is the rate, and the rate does the work. Average card interest in the U.S. has been sitting above 20%, which means the balance is a machine that manufactures new balance while you sleep. This is also where debt stops being a number and starts being a phone that rings. Debt collection is the single most complained about industry at the Consumer Financial Protection Bureau year after year, and the Fair Debt Collection Practices Act exists precisely because the behavior needed a law. Old debts get sold for pennies on the dollar to buyers who often hold nothing but a spreadsheet row with your name on it, and a large share of collection lawsuits end in default judgments, not because the borrower agreed they owed it, but because the borrower never showed up to court, often because they never knew. Sitting alongside Level 5 is the one category that doesn't belong on a ladder of choices at all, because nobody chose it. Medical debt is the only major debt in American life where you agree to the purchase without ever being told the price. You sign a form on a clipboard while in pain or unconscious, and the number arrives weeks later assembled from parts you can't audit. A facility fee, a reading fee, an out-of-network anesthesiologist who happened to be in the room. There was no underwriting, no rate shopping, no comparison. There was an emergency and a form. And because it behaves so badly as a debt, the rules around it have been rewritten repeatedly. The major credit bureaus have moved to stop reporting paid medical collections and to leave smaller medical balances off consumer reports entirely. An admission that this category never predicted anything useful about whether a person pays their bills. Nonprofit hospitals, most hospitals in the country, are required under federal rules to maintain financial assistance policies, and a great deal of that charity care goes unclaimed simply because patients are never told it exists while they're being sent to collections. So the single most common way to acquire serious debt in this country is also the one most likely to be reduced or erased by asking. Almost nobody asks because it does not occur to a person holding a bill that the bill is a starting position. Level 6 is what happens after that judgment, and this is the level that changes your daily life. Once a creditor wins in court, unsecured debt becomes enforceable debt. Now they can garnish. Federal law caps how much of your paycheck they can take, generally up to 25% of disposable earnings, and some states protect more than that, but within those limits it comes out before you ever see it. They can freeze the bank account. They can put a lien on your house that sits there quietly until you sell. Your employer's payroll department now knows. And the thing worth noticing is that nothing about the underlying debt changed at this level. It's the same medical bill, the same card, the same amount. What changed is that it went through a courtroom and a piece of paper turned a request into a mechanism. Level 7 is tax debt, and it's the only debt where the creditor wrote the rules of collection itself. The IRS doesn't sue you. It files a lien by administrative act, and it can levy, take money directly from a bank account, take a portion of wages, seize a refund. Penalties and interest run in the background the entire time. This is the most powerful ordinary person debt in the country, and it is also, strangely, the most negotiable, because the agency would rather collect something than nothing. Installment agreements exist. Offers in compromise exist, where a portion of the debt is settled for less, but almost none of that happens for people who ignore the letters, and ignoring the letters is exactly what fear produces. The pattern at this level isn't a spending problem. It's an avoidance problem, and the system charges interest on avoidance. And then level 8, which breaks the ladder completely because at the top, debt stops being a burden and becomes an instrument. A wealthy person with a large portfolio doesn't sell assets to buy things. Selling triggers capital gains tax. Instead, they borrow against the portfolio through a securities-backed line of credit at rates ordinary borrowers never see, secured by assets that keep growing while the loan sits there. The money arrives, and because borrowed money is not income, there is no tax event at all. Businesses run the same play at scale. Borrow at a rate below what the borrowed money earns, and deduct the interest as a business expense, which the tax code allows for corporate debt and does not allow for the credit card of the person at level 5. There's a name for the full version of this move, and once you hear it, you'll see it everywhere. Buy, borrow, die. You buy assets that appreciate. You never sell them, so you never trigger tax. You borrow against them whenever you need cash, and the borrowing isn't income, so it isn't taxed either, and the loan is eventually settled out of the estate. At no point in that sequence does the person live on a paycheck, which means at no point do they encounter the tax system the way a wage earner does. It isn't a loophole hidden in a footnote. It's just what happens when the rules for selling something are harsher than the rules for borrowing against it. Corporations run the same logic in daylight. A large company carrying billions in debt is not described as struggling. It's described as efficiently capitalized because the interest is deductible and the borrowed money is expected to earn more than it costs. When rates were near zero, The biggest and safest companies in the world borrowed heavily precisely because they didn't need the money. Free capital is worth taking whether or not you have a use for it yet. That is the exact opposite of the person at level 5 who borrows because they have no choice and is charged accordingly. The lending industry prices on risk, and the cruel arithmetic of that is that needing the money is itself the risk. Look at what that means side by side. At level 5, you borrow at 22%, unsecured, to cover a car repair, and the interest is not deductible. At level 8, you borrow at a fraction of that, secured, to buy an asset, and the interest reduces your tax bill. Same word. Same contracts, same lawyers, same banks. The person with the least borrows at the highest price to survive. The person with the most borrows at the lowest price to grow. That gap isn't a lesson in discipline. It's a spread, and it's the quiet engine underneath a lot of what people assume is talent. What makes this ladder so hard to see is that every rung of it looks identical on the screen where you actually encounter your money. Open any banking app and your debts are listed as a stack of tidy rectangles. Balance, minimum, due date, a little progress bar. The mortgage and the payday adjacent installment loan, and the federal student loan, and the judgment all render in the same font, the same color, sorted by amount. Nothing in that interface tells you that one of them takes a year in a courtroom to enforce, and another can empty the account the app is running on. The most important attribute of every debt you own is the one attribute no dashboard displays. So people optimize the wrong variable. They pay down the debt with the biggest number or the one with the highest rate because those are the two things visible to them. Sometimes that's right, but if one of those balances can garnish a paycheck and another can only send letters, the ranking changes completely, and it changes based on information that lives in the original agreement, not on the screen. The order you pay things in should follow the reach, not the arithmetic. So the real question was never how much debt you have. Two people can both owe $40,000 and be living in different countries. One owes it on a fixed mortgage and will hand over a house in the worst case, slowly, with warning. The other owes it on federal student loans and a judgment and can be reached through their paycheck without anyone asking permission. Same number, completely different amount of freedom. Which is why the sentence to look for in any agreement is never the interest rate. That's the number people compare because it's the number that's printed largest. The sentence that matters is the one that describes what the lender gets to do when you fail. Is there collateral, and how fast can they take it? Do they need a judge? Can this be discharged if my life collapses? Those three answers are the entire hierarchy of this video, and they're usually 4 pages in, under a heading nobody reads. Go pull one statement tonight, any one, and find that paragraph. You'll learn more about your actual position in 90 seconds than a credit score will ever tell you, because a score measures how you've behaved. That paragraph measures what can be done to you. If this changed how you think about money, hit like and subscribe for more.